All right, what's up, everybody, and welcome to EMP Money. Today is a very special edition of our daily live AMA. I am AJ, the team lead here, and I'm really excited to welcome not only a personal friend of mine, but an amazing crypto tax expert and tax advisor, Neal McSpadden. How about that for an intro, Neal? Yeah.
That's quite that's quite an intro.
Yes, brother, no doubt. Well, happy to have you, man. And yeah, we're going to keep things pretty broad today. Again,
Mhm.
Neil cannot really give financial advice unless, you are an actual client of his. But I think that a lot of my community, not only wanted to get a little bit of insight of, how to handle broad taxes, how it
Mhm.
applies to DeFi as well. A lot of our community is very DeFi centric, and I know that we're on the cutting edge of finance, especially in crypto. And so I know me and you joke a lot that there really, unfortunately, isn't a lot of clarity. So we just have to kind of operate within the bounds. But I guess real quick, Neil, if you don't mind, can you give us a quick background, both from the accounting standpoint and then how you got into crypto?
Yeah, sure. On the accounting side, I I went through a very unusual kind of process. Most people, go to school for accounting, and that's kind of it. I went to school for engineering, and ended up doing a bunch of day trading back in 2003, 2004, and unsurprisingly, lost a bunch of money doing that. So back then, I didn't know any better. I said, "Oh, I didn't make any money. I don't have to file any taxes." I didn't have any other job. I was trying to make that my main thing at the time, and so didn't make any money. A couple of years go by, start getting letters from the IRS and saying things like, "You owe us $1.3 million in taxes," and I thought that was absurd. So I ignored them, and then they kept sending more letters. I ignored those, and eventually the process goes: they start sending you certified letters, and then they start garnishing your wages if you have any. And that's what got my attention at that point. So so
Yeah, that'll do it,
but
right? Yeah,
yeah,
that'll get
yeah.
your
So
attention.
like my paycheck basically went to zero. I was like, oh, I gotta fix this. So I ended up hooking up with this former Wall Street tax attorney, and he had his own tax practice. And I was like, well, can you help me? And we ended up working through the problem, and ended up owing zero of that, which was great. But it was some hardship in the meantime. And then ended up kind of doing a very old school apprenticeship in that firm, and that was a decade plus ago. And since then, been involved with over 50,000 tax returns, and started my own firm, Tax Sherpa, back in I think we officially started in 2019, but really got going in 2020. And so that's where we are. We've got a tax sherpa, we've got a staff of people on the tax and the book and side, and what we really focus on is tax strategy, where you have these given things in your life. How can we organize those to for the best tax outcome? On the crypto side, I was uh, from the stock trading and everything, I was in all these, kind of trading channels. I started hearing about this Bitcoin thing back in, I don't know, 2010. And I remember, hearing about this stuff, and I was like, well, it sounds interesting. In like many people, when I first heard about it, I thought it sounded cool. I thought, I'll throw $50 at it, kind of see if it turns into anything. And back then, this was 2011. By this point, I remember Bitcoin was trading for 5 cents, and I could not figure out how to buy it. So, there were no exchanges, there was no nothing. You just had to know a guy, and I didn't know any guys. So I tried for a couple days to buy some Bitcoin. Ended up, not being able to, and forgot about it for several years. And obviously, had I been successful in that purchase, we would have been having a very different conversation at this point.
100%. Yeah, well,
Yeah,
no doubt, Neil. Yeah.
yeah. So I came back around to crypto. I don't know, 2016 or so. I started. I heard more about it. Bitcoin had popped by that point to, I don't know, a few $100, and I started doing. Back then, you could buy these little ASIC miners that's stuck into your USB ports. And so I got a little USB strip and I plugged in, I don't know, 8 of these little chips and was mining Bitcoin. And I remember I mined like zero point 0.8 Bitcoin, but there was still nothing to do with it. So there was this service where you could pay people who got Amazon gift cards for their jobs, and then they would buy stuff for you on Amazon for like a small discount. And Bitcoin all went away that way. But then I got in seriously in 2017, and I don't know how much of your community knows about Hive and Steam and all that kind of stuff, but I got into those things, started getting into DeFi in I guess 2018, 2019, and it's been a wild ride.
Yeah, no, 100%, brother. So, and again, I know Neal and my journey as far as getting into crypto is very similar. I met Neal over on Steam. I know we've talked about that in many AMAs in the past. It's now the Hive
Mhm.
blockchain. And again, I don't want to dox Neal too bad, but he's also a major holder in Splinterlands. And so, we
Yep.
talk about that a lot. I know, you see the vision at Splinterlands and play to earn and crypto overall. And so yeah, and really in the world that we live in now, I think that people are relying on QuickBooks or their local big chain tax advisor that has
Hmm.
absolutely no idea about crypto. So I guess I just
Right.
want to start on kind of a high level overview. Again, for those of you that are just coming through, this is Neal McSpadden with his company is Tax Sherpa. And
Yep.
again, you handle corporate clients as well, Neil,
Hmm.
right? Not just crypto related clients. Yeah.
Yeah, for sure.
Okay. So yeah, so he has a wide range of knowledge, and so yeah, I guess let's start off with then maybe the misconception of I think that the big overwhelming I think that people they want to pay their taxes, at least I hope so. Maybe some of you don't, but they just get overwhelmed with what the current laws are. So maybe just go over like a high level overview of what the IRS has laid forward and then what the best way to kind of fit in those guidelines is, and then we can get more specific.
Yeah, I mean, so this is initially like straight off the front of it. You're already at the problem. There is no legislation for crypto taxation. What happened was people back in 2012 or so started asking the IRS. It's like, hey, how should we account for this? And they just said, oh, it's property, and they call it in IRS speak. They call it virtual currency, which is actually technically a slightly broader category than cryptocurrency. Because there were things back in the mid 2000s like e-gold and things like that that would still qualify as virtual currency but aren't crypto. So they just said, yeah, it's property. Just treat it like property, and that's it. And so that was back in 2013. They have released a couple statements since then. They added an FAQ section on their website back, I don't know, several years ago at this point. But fundamentally, that's all they've ever said about crypto. So as property, you buy it, you sell it. There's a difference. You pay capital gains, or if you have a loss, you have a capital loss, which works for some people. So if you are on a centralized exchange and you're buying and selling, then that's kind of okay. That framework works. And over the past several years, how Coinbase and Robinhood Crypto and Binance US and Kraken and all those guys, how they have done the reporting has come more and more into compliance to what you see at a stock brokerage. So if that's all you're doing, then fine, and your tax problems will be fairly simple. The difficulty comes in if you're doing anything else. So if you're doing DeFi, it's like you enter into a liquidity pool, right? So you have token A, you have token B, you put those into a liquidity pool. What is that, right? That because that concept doesn't exist anywhere else. Um, so it starts to open up all these questions. It's like, well, what about this situation? What about that situation? And people get confused very, very quickly. once you go beyond the simple buy sell kind of stuff.
Totally, no doubt. Well, and again, I mean, our protocol operates around liquidity pools, and
Hmm.
we are I'd say that more of a fringe, cutting edge DeFi. I know a lot of our community is into degenerate DeFi, which we'll talk about as well at
Yep.
the end. But so yeah, so on the surface level, then Neil, I guess obviously we like to promote people having custody of their own wallets, their own coins.
Hmm.
And a lot of people that are here, are not on exchanges. So,
Hmm.
on a high level overview, are you needing to report basically every transaction, both in and out of centralized exchanges, or how I guess how to be as safe as you can be, if you end up getting audited, because that's another thing. Like you can kind of stay ahead and try to do the right thing, but until you're actually audited by the IRS, that would be basically when you have to prove, these transactions, right? Because we're
Yeah.
talking, some of these transactions could be literally 5 to 10,000 transactions in a year,
Hmm.
and without
Hmm.
software, it's near impossible to do that by hand. So yeah, go ahead, bro.
Yeah.
Yeah.
Yeah. So so the way the tax code is written, you are, if you're a U.S. taxpayer, and everything I'm saying applies to U.S. only. There are other countries that have their own ideas on what crypto is, and all that kind of stuff. So for U.S. tax purposes, any U.S. taxpayer is required to report all income from all sources. So whether it's on a centralized exchange, whether it's on DeFi, whether it's in the Bahamas, whether it's in wherever, whenever you're supposed to report it. So if you have 5,000 transactions, then theoretically you're supposed to list 5,000 transactions on what's called the form 8949, which is just the itemized list that gets summarized and that goes on your capital gains schedule D. And they say they want that. Now, obviously, without if you're doing all these different things, so the first problem you run into is what is it you are doing. So let's say you're on, let's just use Ethereum just for simplicity. There's your transaction log on Etherscan, and you know what is each thing? Is it a purchase? Is it a sale? Is it a loan? Is it any other organization of transaction that you could have between two parties? Is it a capital contribution to something? Is it you know, is it a gift? Who knows? Everything depends on facts and circumstances. So as soon as you take that step, so like if you have funds on a centralized exchange and you transfer them to your own wallet, that's just a transfer between your money in place A and your money in place B. So that's not a reportable transaction. That's just it's just like putting money from one bank account into another bank account. But as soon as you take that wallet balance in Ethereum and then you do something with it, then you possibly have a reportable issue. So yeah, so you're supposed to report each and everything. It's what they say they want. In now, you said when you get audited. Well, it's not not everybody gets audited. So you have a relatively low average chance of getting audited just at random. But whatever claims you are making on a tax return, this applies to everything. You are telling the government this is what happened this year, for tax purposes. And whatever you say on that statement, you're supposed to be able to back up, with your records. Should they come asking, and that's what an audit is. An audit does not mean that you did something wrong. They're just saying, okay, you said this thing, let's prove it. And you're supposed to be able to back up whatever claims you make. So, so will people put 5,000, 10,000 transactions on their tax returns? I have not. I typically the answer there is most people don't. They'll summarize, which the IRS says they don't want you to do, but they do it anyway. And then yeah, you come up with those people come up with kind of a net number. But you're right. Without software, virtually impossible if you're doing any kind of volume. Um, the there are software packages that are starting to be developed. Again, they're not great. I've yet to find one that can actually handle every type of transaction. Because once you start bridging to other blockchains and doing things, everything gets messed up. But if it's sort of like where we are with the centralized exchanges. If you're doing one thing in one box, like if you're on Ethereum and you're only on Ethereum, then some of them kind of work okay. But if you're bridging to Binance Smart Chain or to Avalanche, or you're going over to Polkadot, parachains, then all bets are off when it comes to those software packages.
Yeah, 100%. Well, and again, I know this is definitely not, a sales pitch for Neal. I know he was very, very kind to come on and give some advice here. But I think that the overall, again, goal with this is that if you have a substantial holding in crypto, it is best to find a tax, professional that has crypto knowledge because, again, I think that there's a lot of ways to, save. And I don't mean that in a devious way. I mean that in a legit, way of playing within the rules. And one of those things, Neal, and again, we can go into this and then we'll start taking some questions. But I know a lot of people have really taken advantage of Aave and actually lending their crypto,
Mm-hmm.
and that is not a taxable event, right, Neal? Or can you kind of go into that of how people are able to kind of avoid having to claim, on loan crypto. Yeah.
Right. So with Aave, you're depositing funds, one kind of coin into some kind of smart contract, and you get two things in return. You get a token tracking coin, which it says which represents your position within the smart contract, and then you get whatever you're borrowing out of it. USDC or Bitcoin or whatever. So the IRS, according to their rules, they're saying every transfer of cryptocurrency or virtual currency, as they call it, is a property event. So you're immediately faced with the question. It's like, well, okay, so let's just say I sent 100 USDC into this this other wallet address, and I got back 100 AUSDC. So that's a swap, right? That's a capital gain event. So if I do that, then what is the price of that AUSDC? In some cases, depending on what you're doing, it might be zero. In which case, I just lost 100 USDC or 100 dollars worth of virtual currency value. And I got back this thing which has no value, but might turn into value later on. If I swap it back, and then I have this loan of this other stuff, and loan proceeds are not taxable income. Just across the board. So depending on your viewpoint of what actually happened there, it might just be a loan, or it might be a capital loss plus a loan. So everything depends on the specifics of what is actually going on, and how literally you are interpreting the IRS's position that each token is its own property.
All right, sorry about that. I was still muted on YouTube. So yeah, absolutely, Neal. And again, I think that there are a lot of very advanced strategies that you can implement, to maximize where you're at. And again, it boils down to, and we talk about this a lot on RMAs, like we're proponents of regulation. I mean, we again, I think that once we have a much clearer actual legislation, or I call it a rule book, that we have to
Mhm.
play inside of, like that will really help further adoption as well. And I think, not only will it make things more clear, but in the long run, make things a lot more make things a lot more mainstream. So, all right, awesome, man. Well, I have a few questions for you. Let me get started here. One second. All right, so the first question that we have is, all right, so in ROI style contracts, so in other words, we have one here at EMP called the Detonator, or another
Mhm.
comparison could be even maybe mining rewards. is it a
Hmm.
taxable event every time that an action is made or a reinvestment happens, or is it only taxable on like actual withdrawals?
Yeah. So with EMP style contracts, you're putting that money in, and then it's gone as far as the user goes, right? It's locked into that contract. You cannot get it back.
Correct. Yep.
So and I'm in the I think it's the reactor one, whatever
Yep.
the eShares BNB one is.
Yep. Reactor.
Um,
You're on it. You're an expert, Neil. Yeah, you've done it, bro.
so
Yeah.
so yeah, so what happened was, I sent, my eShares and my BNB to this other wallet in exchange for effectively nothing. A promise in the future to get paid out every day. So from my perspective, as trying to follow the rules for property transfers, is that, well, I just lost whatever the dollar value of my deposit there was. And then on the other end of things is that when I get a payout every day, then that that amount is now income. Um, and then, so what happens is, let's say I get a daily payout. It's $1 worth of US dollar value. I have income of $1. Then the question becomes, what do I do with that? Right? If I deposit it again, then it goes away again. If I trade it for a dollar of something else, well, then I have a $1 income, and then I have a $0 gain on that swap. If I bring in a dollar, I wait, let's say 30 days, that dollar of stuff is now worth $2. Well, let's say $5, just to make the math a little bit clearer. So now I had $1 when I initially got that income, and then my basis was $1. So that $1 to $5, that becomes a $4 capital gain. So it's all trying to trace out what exactly happened over the course of time, in a given calendar year. So yeah, so my opinion is that in that style of contract, I deposited whatever it was. That's a complete capital loss, and then the other payouts every day become income.
Perfect. All right, beautiful. And so, follow-up question to that is, what happens if a ROI contract, rugs or goes to zero? Are you able to write that off? And can I write off a sunk cost, I guess, meaning, and you kind of already answered that just now, in locked deposit contracts, typically that's a sunk cost, but you're saying, you don't have to worry about that until income is actually made. But how about like I guess tax loss harvesting or losses, I guess. Yeah.
Yeah. So with the ROI style, you've clearly burned whatever value you had on the front end in exchange for that income over time. For a different kind of liquidity pool, like a sushi swap or whatever, like a normal yield farming kind of thing, it really depends on what your view is of what happened originally. So if you're viewing that initial deposit into the liquidity pool as a loan, then if and when it so when you make a loan to somebody, there's no deduction, no nothing. It's just you made a loan, and any interest you receive back will be interest income. If you view it that way, then if they rug, then that loan defaults and you write off the loan as a bad debt. On the other hand, if you view it as, well, I exchanged, tokens A and B for token C, which is my liquidity pool token, which has zero value, and so that's 100% loss at that point. Then if they rug, it has no effect because you've already taken the loss on the whole thing. So it's it all comes down to the details, which are going to be subject to each person's individual situation.
For sure, no doubt. And I correct me if I'm wrong too, Neil. Again, I learn from you every single time we have a chat. But how long? Like you can apply your losses up to, is it 2 or 3 years? In other words, like if you do really well during a bull market, but you've
Mhm.
lost all the money, you've lost a ton of money in a bear market. Are you able to kind of carry that over or yeah?
Yeah, so with capital gains, what happens is if you have a loss, they in any like I'll give my own example. So, back in 2003 or something, I lost like round number $100,000 in stock trading, and the IRS does not allow you to deduct that $100,000 of losses all at once because their idea is that, well, if we allow people to do that, that will incentivize people taking crazy risks. So we're gonna limit how much capital loss you can take against other kinds of income. So they limit you to $3,000 a year. So I have a $100,000 loss. $3,000 I can take this year. $3,000, and the remainder rolls over, forward into the future. $3,000 rolls over to the next year. $3,000 to the next year. $3,000 to the next year. So it's been like, for me, it's been like 15 years. I'm still writing off $3,000 a year, and that loss will carry forward until you either use it all up at $3,000 a year or until you have enough other gains to offset it. So, if you have a $50,000 loss in 2021 and you have a $75,000 gain in 2022, then, that 50 will have rolled over and subtracted from the gain of 22. And you'll be left with whatever the difference is, $25,000 of gain. And that'll be your net taxable capital gain on your new tax return.
Gotcha. All right, no, awesome. Okay, killer. All right, I have, and we're gonna go a few more questions here. In the meantime, though, please like, comment, and subscribe for any of you listening to this live or the recording. And I'm sure that Neal, we'll be able to have him back again. I know a lot of you were really excited for this, and if there is questions that we don't get to, please feel free to leave them in the comments for future AMAs with Neal. And while we have a little more time, even today, if there's a question you'd like to ask, please put it in the actual chat, the live chat of YouTube, instead of Telegram or Discord. So, all right. The next question is, hang on one second, let me find it. All right, so this person says, I haven't taken out any amount of money in crypto back to the bank. I was going to pay taxes on anything I bring out of crypto. Is this a terrible strategy? Yeah.
Yeah. So I can tell you this is not what they want. So you're supposed to report everything. DeFi, CeFi, whatever. I have heard people come with this strategy, and I'll tell you, if you get audited, you will lose. So make of that whatever you want.
All right, there you have it. Sorry, I was muted again. I'm talking, and I'm notorious for that. So, all right, yep, there you have it. So again, that's why it's really important to find a tax professional that can help. So, and Neal too. Again, I know this was definitely out of the kindness of your heart, no ulterior motives, and I don't even know if you're
Mhm.
accepting new clients, but if people are wanting to maybe actually have you as their tax advisor. Do you want me to send them to Tax Sherpa? Or, I mean, are you even accepting new clients at the moment? I don't know. I'm sure we're
Yeah,
gonna get those
yeah.
questions. Yeah.
We are accepting new clients. I've actually been really sick this year with long COVID stuff. So I recently hired some new staff to take up the slack. But yeah, I mean the best thing to do is just to email office at taxsherpa.com.
Perfect. All right, there you go, everybody. And I'll put that in the link too. So, all right, we have a few more here. I want to be very respectful of your time, Neal. So this, and again, some of these questions coming up, I think it's better if we talk hypothetically, just so that we're covering ourselves here. But this question is, if we on ramp through Binance US, but then off ramp through a foreign exchange or an Asian bank account. Is this a taxable event? So, and maybe on top of that, maybe just go over a little bit about like, offshore accounts. Like, I don't know, if you have any experience with those. I know you can hire some third-party services. So yeah, go ahead, Neal. Obviously,
Yeah,
hypothetically
yeah.
speaking. Yeah, go ahead.
So hypothetically speaking, but so the U.S. has one of the most aggressive tax regimes in the world. So they don't care where the money went. You are responsible for reporting your worldwide income to the U.S. And if you paid taxes somewhere else on a certain chunk of income, then you may or may not get a credit for that amount of tax you paid there. So it doesn't matter if you onboard in US and then offload in Cyprus or something. You're still responsible for reporting that income to the IRS. And in I don't know, the last 10 years or so, there's been this push for what they call, it's a lovely euphemism. It's tax harmonization. And what tax harmonization means is that all the governments of the world talk to each other about, who's doing what as far as money flows and potential tax liabilities. So, the days of when, you could just, go to the Cayman Islands or something and just, take out money there and nobody's the wiser, that kind of tax evasion is long gone. So yeah, that's not a viable tax strategy. That you're still supposed to report that on your U.S. tax return. For any gains or losses, like the total amount is not so relevant. It's you report your proceeds and your cost basis, and the difference becomes taxable. But then if you are converting to one of those other fiat currencies, then there's a whole separate issue of the FBAR, where if you have it's the foreign see if I can remember the acronym correctly, Foreign Bank Account Reporting Act, where if you have money in other countries, then you're supposed to report it to the DOJ annually, and you list your account numbers and how much was in that account during that year. And they want that in case they ever decide to come after you. They want to know where all your stuff is. What's interesting about the FBAR though is that property is exempt from it, so it's only financial account type stuff. So so far, they have actually exempted cryptocurrency from that because it's property and it's not actually currency. So just like foreign real estate does not require reporting under FBAR, but bank accounts and things like that do. So, that triggers when your combined balances on any given day exceed $10,000 during the year. So, just be aware of that. And if it's over 50, there's another form to file in addition to the FBAR, but that's a kind of probably beyond the scope what we're
Yeah.
talking about here.
Yeah, no, that's great. Those are great, again, thresholds to be wary of. And again, this is another spur question off of that. I know a lot of things I see popping up are like buying gift cards, back to kind of what you had said in the beginning of this AMA. Buying buying gift cards with crypto, or even paying off credit cards directly through a crypto, service. Both of those are still considered income, right, Neil?
Um, yeah, so when you have one of those events, you're paying off the credit card or you're buying the gift card, then you are exchanging that crypto for a value, at that point in time. So that'll whatever that the price is on that day of that crypto, then you're going to have a capital event there.
For sure. All right, cool. And I know all of this is in regards to U.S. tax, laws, as we said earlier. But I did skip a question. I apologize. So it's kind of a long one. So let me go through everything, and it is specific to EMP. I think that you answered it pretty much already, but I just want to recap. So it says, so in my country, I have to report all earnings as income using the price at the point of the reward using the price at the point the reward was delivered. So technically,
Hmm.
taxes associated with EMP rewards can end up way greater than the actual value. And their follow up to that was, I'm looking to confirm that technically your income tax liability would be greater than the value of the rewards that you hold, given it's gone down so much. So again, just to kind of recap, Neil, I think the fear is that being in sort of these detonator style contracts is that your tax liability is larger than what the rewards actually become. However, based on what you said earlier, the income really isn't calculated until you claim. So and again, you can elaborate, but in my mind, that means that that there wouldn't really be a situation where the tax liability, if anything, you're getting less liability claiming while the market is down rather than while the market is up. But does that make sense?
Well,
Yeah, go ahead.
yeah. So I get the idea of the question. It can happen. Yes, is the short version. So just it happens in other things too. So I have a client. She works for one of these San Francisco tech companies, and they had an IPO in, I don't know, 2020, I think. And so most of her compensation is in stock shares, and so she had a huge year when they IPO'd. Like over $1 million worth of income. But then when it came to actually file the taxes, she had held her shares, and they had gone down since the IPO. So now she has an income tax liability on $1 million, but now it's only worth $600,000. So that is a real situation that does happen. So if you claim some rewards and you are sitting on the tokens, then you have that income at on the value of that day that you claimed it. But then something happens in the meantime, and your value can evaporate. And that's not specific to EMP. That's just anything, right? So crypto is
For
very
sure.
volatile, and yeah, and things can go up, things can go down. Last year or so, things have been down. um, so yeah, so if you're holding a coin that you have an income tax liability on from when you got it, and then it goes down, then it certainly could be that the value that you have at the end of that is less than uh, what you started with, and possibly less than what the tax is in total.
No,
Depends
100%.
on the relative numbers of everything.
Yep, that makes sense. So, okay, I appreciate you clarifying. And I think, and so maybe a good practice, and again, Neil, this is what I do. So this is why that question was a little bit, where I said, it may actually benefit you, is that when you actually claim rewards, and you're looking to kind of, take profit, so to speak, you convert right to a stable token. And I think that
Hmm.
that can avoid, a lot of that potential. Obviously, you don't have the upside either, but you don't have the
Right.
downside liability as well. So, is there anything you want to maybe add on stable tokens, Neil? Like, if you're holding a stable token, that's just essentially, like having money in the bank in terms of the way the IRS looks
Depends
at
on
it.
which
Or,
stable coin,
yeah,
right?
exactly, right. Unless it's Luna, right? No, yeah, so
Yeah.
too soon, too soon. Yeah, so
Too soon.
yeah. So, yeah, go ahead,
Uh,
Neil.
yeah. So I mean, fundamentally, stablecoin is no different than any other crypto from a tax perspective. But because it always, at least most of them, trade right around that $1, if you're converting to and from that, then you can rely on that, reasonably well as just being like a $1, um, you know, uh, storage. So yeah, I mean, if you're earning rewards and you're converting them to a stable coin every day, then you'll just have that income, and then you won't have that problem of the token that you're holding going down. Now, I should say on that situation where it went down, if and when you do sell it, you'll have a loss. So that may or may not counteract the that original gain that you have. So everything depends on the specific numbers involved. But yeah, I mean, the cleanest thing to do is convert to stable coins. You lock in your gain or loss at that point, and then you don't have to worry about well, I won't say you won't have to worry about, because stable coins can go bad, but
Totally.
hopefully your stable coin remains stable, and you don't have to worry about the ups and downs of other tokens. But like you said, when you do that, you are removing yourself from that speculation. So maybe that works out in the market, maybe it doesn't. Just depends on how things go and what your viewpoint of the future is.
For sure, for sure. Well, and that's a great segue into because that's really all the questions I see. If there are more, let us know. But that was a perfect segue about the future. So Neil, and again, this is just a conversation between two crypto dudes. Now we're not really talking about the tax implementation, but I know that I think you and I have a very similar mindset. We've been through multiple bear markets now. What is your feeling on crypto moving forward and into the future, both from a financial standpoint, as well as an adoption and regulatory standpoint as well.
Yeah. Well, how much time do we have? um,
Yeah,
so
isn't that the
I,
truth? We have a whole AMA on
yeah,
that. Yeah, so go ahead, brother.
yeah. Let's do the market outlook first. Now, obviously, this is just my opinion, no financial advice expressed or implied, and blah blah blah. So, over the past couple of years, people have been talking about, we need institutional adoption and, institutional adoption. Well, that's what we got. So now we have the crypto markets that are tied pretty tightly to the stock markets. Like when the NASDAQ goes down, the hedge funds that have crypto exposure, they have to raise money for margin calls and they sell their Bitcoin first. And then, as Bitcoin goes, the rest of crypto goes. So I think we're pretty tightly bound to the stock markets at this point. And, stock markets have not been in great shape lately. The Fed has been raising rates and people are expecting them to taper off here shortly, but, maybe not. Maybe we get a recession in 2023, like some people are predicting. So, personally, I think 2023 is going to be kind of rough for everything, including crypto. And then I'm a little bit more optimistic on the back half of 2023 and up into 2024. Now, when it comes to adoption and all that kind of stuff, we're seeing a lot of adoption. We saw what happened in El Salvador. Panama's been making noises. There was another country in Africa, I forget which one, was talking about doing stuff. And then, so adoption is spreading. It's a slow process. My view on this is like a 10 or 20 year kind of time horizon. But over that time period, I do think we actually see that crypto ends up winning the monetary competition with fiat currency. I realize that's kind of an extreme view, but I think that the technology is so much better than what we have for fiat that people will, the market will win over, the fiat dictates that it's like, oh, this is the currency that you have to use. And I really think that the CBDCs, the central bank digital currencies, I think those are going to shoot those governments in the foot. Because what they will effectively end up doing is they will get people used to crypto type stuff, transacting on your phone, scanning addresses and doing all that kind of stuff. And then there will be some horror stories, people getting locked out of buying this or that. And, you turn around and everything's gone. And all those kinds of things will happen. And then over time, people realize, well, I can do the same kind of thing on my phone, for storing money in a wallet and transferring for buying and selling, but I can do it with crypto and not be subject to this government regime controlling the currency. So I really think that is actually the gateway for widespread crypto usage and adoption.
Amazing. Yeah, brother. And again, I agree 100%. I think, it's gonna, and I also think it's a generational thing. As horrible as that
Mhm.
sounds, I think that we do have to have, the tide turn, where, people that are used to using phones and the digital age, that is when I think, adoption will also really spark. So, all right, awesome,
Mhm.
brother. I have two more follow-ups, and then we'll let you go. This one should be pretty fast here. So, someone says, I sacrificed some money to Richard Hart's. I won't say what he called him. Another word for Richard, but yeah, PulseX or Pulse Chain. Are those considered donations? What that can be written off? Or how does sacrificing work? So I know that's been a hot topic. A lot of projects, even like managed funds, are saying it's a sacrifice to kind of get around
Mhm.
some regulatory issues as far as SEC goes. But how does that work from a tax perspective?
Yeah, well, I mean, I'm not familiar with PulseX or Pulse Chain. I never uh, got involved with any of that. So you got to look at the specifics of what happened. Did you make a loan that went bad? Did you contribute something and receive a token back that was worth nothing? Did you just send money into the void? Certainly not a donation, because there's not a charitable entity on the other end of that. But you'd have to really look at the exact facts and circumstances of what happened in that transaction to determine what happened.
Okay, for
So
sure. Yeah.
I know it's a general, non-specific answer, but no, that's just how it is.
Yeah, no doubt. Well, and again, I'm a little more familiar with it. So the way I'm treating it right now is, it is just out in the ether. So, sending your money into the void, that is kind of how, you have to look at it. But all right, cool. And then this one might be a little bit outside your scope, Neil, but I had a lot of people ask me about it before AMA. I know there's been a lot of chatter, especially for U.S. citizens, about Puerto Rico. I know a lot of
Hmm.
people, have some advantages moving to Puerto Rico, even
Hmm.
having a business started in Puerto Rico. Are
Hmm.
you familiar with any of that, or any? Can you add maybe what that would require, or yeah, I don't know.
Yeah,
Go ahead. Yeah.
yeah. So I don't do Puerto Rico taxes, but I am generally familiar with the idea. So Puerto Rico, back in the day, they passed what they call Acts 20 and 22, and then they updated them to Act 60 here in the last couple of years. Basically, they're trying to incentivize people moving to Puerto Rico and investing in the local economy. So Puerto Rico is a very strange beast when it comes to taxes. It's a territory, not a state, and so they have their own tax system. They don't pay federal taxes. So the gist of the idea is that if you are a resident of Puerto Rico, you live there more than 6 months during the year, and depending on the year, they have different requirements. Sometimes you have to buy a house, sometimes you have to hire locals, sometimes you have to contribute a certain amount to a local charity, and so you have to get expert guidance on boots on the ground there, and there are companies that do that for Puerto Rico. But if you satisfy all those requirements, item number one is that if you have a company that provides services to mainland U.S. companies, that income into that Puerto Rican entity becomes effectively tax free. And then they also have like a very low capital gains rate, like on the neighborhood of 4%. So a lot of crypto bros have moved to Puerto Rico to take advantage of that, and yeah, that works. The flip side is you're living in Puerto Rico, which some people like, some people don't. I have actually several clients that have done the Puerto Rico move, and some of them have moved back because the nice parts of Puerto Rico, where all these tech people are living, the housing costs have just gone insane, and more than counteract the tax savings of the whole thing. So there's definitely details you want to figure out, but yeah, it's a viable strategy if that works with your lifestyle.
Yep, 100%. Awesome, brother. Well, again, man, I really appreciate your time. I know you've had a rough go of it from a health perspective, and talking for an hour might not have been the best thing that you wanted to do today. But again, brother, I appreciate you coming on. Maybe we'll do a follow-up AMA with Neal in the new year. Again, I know we're coming down to the end of the fiscal year, so hopefully this helps some of you. Again, the overall arching, discussion, just to recap, is that really, the income is calculated when you actually harvest, or, in terms of EMP specifically, when you're
Mhm.
withdrawing from, these ROI style contracts, and then when, again, any trade is made between EMP and ETH. And you touched a little bit on liquidity pools earlier, Neal, and that's kind of
Mhm.
a beast all of its own. But
Yeah.
I'm assuming, again, I mean, the rebalance in the liquidity pool could be once every 2 seconds. So, is it basically just the in and out of that liquidity pool, or
Yeah.
is there still? Yeah, go ahead. Yeah.
Yeah, so the liquidity pool, whatever's happening to those coins is not in your wallet. It's in the liquidity pool's wallet. So the the daily trades that are going on internal to that don't affect you. It's just going to be the in and out that actually coming into your control or out of your control.
For sure.
Um, so like with I have a question for you though. I actually have not looked at the blockchain data about this. So like if I'm in the reactor, if I hit claim, obviously the liquidity pool tokens come into my wallet. If I do the compound, do they ever hit my wallet, or do they stay with with the
Yeah,
contract wallet.
so they do not. They do not hit your wallet. They stay in the contract, and that was a purposeful, addition. So yeah, that shouldn't incur, another transaction for sure. Yeah.
Yeah,
Yeah.
that sounds right to me.
Yeah, awesome, brother. All right, cool. Well, again, everybody, I appreciate you being here. Neal, thank you again, my friend. And again, this is Neal McSpadden with Tax Sherpa, and we'll put the link to his business in the comments. I promise. This was not a shill, right? So no, Neal
Yeah.
just has been a really good friend of mine, and we go way back, and I know a lot of you were asking about some tax coverage as we go into the end of the year here. We had a great turnout. There's about 50 people on the live stream. So thanks to everybody
Great.
for being here. And yeah, if there's any follow-up questions, please feel free to post them in the comments of this video. And then when we have Neal back on, we'll go through all those. So, all right, brother. Thank you again. Happy holidays to you. And we will be in touch.
All right. Happy holidays. It was
All right.
great.
All right. Bye bye, everyone. Thank you.